This is an emergency broadcast. I need you to sit down. I need you to take a deep breath. And I need you to understand that what I am about to show you is not a correction. It is not a healthy pullback. It is not a buying opportunity. What just happened in the last 24 hours is the most violent, brutal, terrifying price collapse in the history of the modern silver market. And if you do not understand why it happened, if you do not understand who just made billions of dollars while you were sleeping, you are going to make the same mistake twice. It is Thursday, January 30th, 2026, and exactly 48 hours ago, silver was trading at $122 per ounce. We were celebrating. We were cheering. We were telling you that the paper market was broken, that the system was collapsing, that silver was going to $200, $300, maybe higher. The chart was vertical. The momentum was unstoppable. The shorts were bleeding. The retail investors were euphoric. And then, at exactly 9:47 a.m. Eastern Standard Time yesterday, the floor disappeared. Silver didn't drop. It didn't pull back. It didn't correct. It collapsed. It fell through every support level like they didn't exist. It dropped from $119 to $99 in the first hour. Then it kept falling. 95, 92. And by the close of trading yesterday, silver was sitting at $90 per ounce. That is a $30 drop from the peak. That is a 22% decline in less than 24 hours. That is not a market move. That is a massacre. Ladies and gentlemen, this is the money code, and we need to decode what just happened. We need to explain why the most powerful investment bank on Wall Street just issued a report calling silver a speculative bubble and predicting a crash to $50. We need to expose the profit-taking bloodbath that just wiped out billions of dollars of retail wealth in a single trading session. And we need to tell you the truth about whether this is the end of the silver rally or just the beginning of the next leg up. You have to understand the context of this crash. This was not random. This was not organic selling pressure. This was a coordinated, calculated, premeditated execution. The big money, the institutional players, the banks that have been shorting silver for decades, they saw the euphoria. They saw the retail investors piling in at $115, $120, thinking they were going to ride this to $200. And they decided to pull the rug. Here's how it works. When silver hit $122 on Tuesday, the futures market was on fire. Open interest, the number of contracts betting on higher prices, was at an all-time record. Retail traders, hedge funds, even some institutional buyers were leveraged to the maximum. They were using margin, borrowed money, to buy silver contracts because the momentum looked unstoppable. But leverage is a double-edged sword. It amplifies your gains when you're right, but it obliterates you when you're wrong. The banks know this. They have been playing this game for 50 years. So what do? They waited until the exact moment when the most people were long, when the most capital was exposed, when the sentiment was at peak greed. And then they hit the sell button. Not a small sell, a tsunami sell. Billions of dollars of paper silver dumped onto the market in minutes. The price started to drop, and that's when the death spiral began. When the price drops, the margin calls start. A margin call is when your broker taps you on the shoulder and says, the price moved against you. You need to deposit more cash, or we're closing your position. And when you're leveraged 10 to 1, a 5% drop in price wipes out 50% of your capital. A 10% drop wipes you out completely. So the retail traders, the ones who bought at $120, they got margin called at $115. They had no choice. They had to sell. And their selling pushed the price lower, which triggered more margin calls, which forced more selling. It's a feedback loop. It's a liquidation cascade. And it doesn't stop until every leveraged long position is destroyed. By the time the dust settled, silver had dropped to $90. The retail investors who bought the top are now sitting on 25% losses. The hedge funds that went long on momentum are bleeding. And the banks, the ones who sold at $122 and covered at $90, just made $32 per ounce on every contract they shorted. That is billions of dollars in profit. They didn't just win, they massacred the competition. But the crash itself is only half the story. Because while the blood was running in the streets, while the retail traders were getting liquidated, one of the most powerful voices on Wall Street decided to twist the knife. We need to talk about JPMorgan. We need to talk about the report that just sent shockwaves through the precious metals community. Because what JPMorgan just said is not a warning. It is a declaration of war. Late yesterday afternoon, as silver was sitting at $90, still reeling from the crash, a report started circulating on every trading desk from New York to London to Singapore. It was from Marko Kolanovic, the former chief global market strategist at JPMorgan. This is not some junior analyst. This is one of the most respected, most feared, most influential voices in global finance. And the title of his report was Simple, Brutal, and Designed to Terrify You. It said, silver to $50, speculative mania over. Let me read you the exact quote, because you need to hear this in his own words. Kalanovich wrote, "The recent parabolic move in silver is reminiscent of the meme stock frenzy of 2021. It is driven not by fundamentals, but by speculative excess, social media hype, and leveraged macro instruments. The industrial demand story is overstated, the supply shortage narrative is exaggerated, and the comparison to the 1970s inflation hedge is flawed. We expect silver to retrace to its fair value range of $45 to $55 per ounce within the next 6 months, as profit-taking accelerates and the retail bid evaporates." Do you understand what he just did? He didn't just predict a crash. He called you, the retail investor, a meme trader. He said your analysis is wrong. He said the shortage is fake. He said the rally is a bubble. And he put a $50 price target on silver. That is a 45% drop from current levels. That is a total collapse. Now the mainstream media is running with this. CNBC is running the headline, JPMorgan calls top on silver. Bloomberg is saying speculative bubble bursts. The financial press is using Kalanovich's report as proof that the rally is over, that the smart money is selling, that you should get out before it's too late. But here's what they're not telling you. Here's the part of the story that the mainstream media is conveniently ignoring. Marko Kalanovich doesn't work for JPMorgan anymore. He left the bank 6 months ago. And do you know why he left? Because his calls have been catastrophically wrong for the last 3 years. He told clients to short the stock market in 2023. The market went up 25%. He told clients that inflation was transitory in 2024. Inflation exploded. He told clients that gold would crash in 2025. Gold doubled. This man has been wrong on every major macro call for years. And now he's telling you to sell silver. But it gets even more suspicious. JPMorgan, the bank that Kalanovich used to work for, is one of the largest holders of physical silver in the world. They have been accumulating silver for a decade. They have warehouses full of bars. They have been long silver while simultaneously shorting the paper market to suppress the price so they could buy more physical at a discount. This is documented. This is proven. They paid hundreds of millions of dollars in fines for spoofing and manipulating the silver market. So when a former JPMorgan strategist comes out and tells the public that silver is going to $50, you have to ask yourself, who benefits from that narrative? If retail investors panic and sell, if the price crashes, who is sitting there ready to buy the physical metal at a discount? JPMorgan. This is not analysis. This is propaganda. This is a psychological operation designed to shake you out of your position so the big money can take it from you. But let's be honest. Let's look at the data objectively. Because even though Kalanovich is a compromised source, even though his track record is terrible, that doesn't mean the crash isn't real. The price did drop 22%. The momentum did break. And we need to analyze whether this is the end of the bull market or just a violent correction within a larger trend. We need to look at the technicals. We need to look at the fundamentals. And we need to give you the truth, not the hopium. Let's start with the chart. From a technical perspective, what just happened is called a parabolic blow-off top. This is when an asset goes vertical, rises too fast, too far, and then collapses under its own weight. We saw this in Bitcoin in 2017. We saw it in GameStop in 2021. And we just saw it in silver. The move from $30 to $122 in less than a year is a 300% gain. That is parabolic. That is unsustainable. And when you get that kind of move, a 20% to 30% correction is not just possible, it's inevitable. So the drop from $122 to $90 is actually textbook behavior for a parabolic asset. It doesn't mean the rally is over. It just means the market is shaking out the weak hands, the leveraged speculators, the people who bought the top with borrowed money. This is healthy. This is necessary. Because if silver is going to go to $200, it can't do it in a straight line. It needs to build a base. It needs to consolidate. It needs to let the weak hands sell to the strong hands. And here's the key technical level you need to watch. The $85 to $90 zone is a major support level. This is where silver traded back in November before the final parabolic move. If silver holds above $85, if it bounces from here, then this crash is just a correction. It's a bear trap. It's the last chance to buy before the next leg up. But if silver breaks below $85, if it falls to $75, $70, then we have a problem. Then the technical structure is broken. Then Kalanovich might actually be right, and we could see $50. But the chart is only one side of the equation. We also need to look at the fundamentals. And this is where the JPMorgan narrative completely falls apart. Because the fundamental case for silver is stronger today than it was at 30. Let me show you the data that Kalanovich conveniently ignored in his report. The global supply and demand imbalance is real. According to the Silver Institute, global silver demand in 2025 was 1.2 billion ounces. Global mine supply was only 830 million ounces. That is a deficit of 370 million ounces. That deficit has to be filled by recycling and above-ground stockpiles. But the stockpiles are shrinking. The COMEX registered vaults are down 70% from 2020 levels. The Shanghai Gold Exchange inventory is at record lows. The physical market is tight. This is not a narrative. This is math. And the industrial demand is accelerating, not slowing down. Solar panel production is at record highs. Electric vehicle production is ramping up. 5G infrastructure is being built globally. All of these technologies require silver. And unlike gold, silver gets consumed. It doesn't get recycled efficiently. Once it goes into a solar panel or a circuit board, it's gone. So every year the above-ground supply shrinks while the demand grows. That is the definition of a bull market. But here's the part that Kalanovich really doesn't want you to think about. The monetary demand, the flight to hard assets, the collapse of fiat currencies. Because while silver was crashing from $120 to $90, gold was still sitting at $400 per ounce. Gold didn't crash. Gold held its ground. Do you know why? Because gold is money. Gold is the central bank asset. Gold is the flight to safety. And when gold is at record highs, it means the monetary system is in crisis. It means people don't trust the dollar, the euro, the yen. They trust metal. And here's the kicker. The gold to silver ratio. Right now, with gold at $400 and silver at $90, the ratio is 60 to 1. That means it takes 60 ounces of silver to buy 1 ounce of gold. Historically, that ratio is 15 to 1. Geologically, it's 8 to 1. So even at $90, silver is still undervalued relative to gold. If the ratio corrects to 30 to 1, which is conservative, silver should be at $180. If it corrects to 15 to 1, silver should be at $360. So here's the truth. The crash from $122 to $90 is painful. It's violent. It's scary. But it doesn't change the fundamentals. It doesn't change the supply deficit. It doesn't change the industrial demand. It doesn't change the monetary crisis. All it changes is the sentiment. And sentiment is driven by fear and greed. Right now, fear is winning. But fear creates opportunity. And speaking of opportunity, there's one more piece of this puzzle that we need to address. Because while the silver market was imploding, while JPMorgan was issuing bearish reports, something else happened in Washington that could change everything. We need to talk about Kevin Warsh. We need to talk about the man who's about to control the Federal Reserve and what his appointment means for the price of silver. Let's go to the Fed. Let's see what happens when an inflation hawk takes the throne. While the silver market was melting down, while retail traders were getting liquidated, President Trump dropped a bomb that most people missed. He announced his nomination for the next chairman of the Federal Reserve, the man who will replace Jerome Powell in May 2026, the man who will control interest rates, control the money supply, control the fate of the dollar, and that man is Kevin Warsh. Now, if you don't know who Kevin Warsh is, let me educate you. Warsh is a former Federal Reserve governor. He served during the 2008 financial crisis. He is a conservative, hard money, inflation hawk economist. He believes in tight monetary policy. He believes in defending the dollar. He believes in raising interest rates to crush inflation, even if it crashes the economy. This is the exact opposite of Jerome Powell, who has been printing money, holding rates low, and letting inflation run hot to save the stock market. So what does Warsh's nomination mean for silver? On the surface, it looks bearish. If Warsh raises interest rates, if he strengthens the dollar, if he crushes inflation, then the monetary demand for silver should drop. People buy silver as a hedge against inflation and currency debasement. If those threats disappear, the demand disappears. This is the narrative that JPMorgan wants you to believe. This is why the market sold off when the Warsh news broke. But here's what the market is missing. Here's the fatal flaw in that logic. Warsh can't actually stop inflation. No one can. Because the inflation we're experiencing is not monetary inflation. It's structural inflation. It's driven by supply chain breakdowns, energy shortages, geopolitical chaos, and decades of underinvestment in commodities. You can't fix that with interest rates. All you can do is crash demand. All you can do is trigger a recession. And when the recession hits, when unemployment spikes, when the stock market crashes, the Fed will be forced to cut rates again, they will be forced to print again, and when they print, silver goes to the moon. This is the cycle. This is the trap. Warsh thinks he can fight inflation with tight money. But the moment the economy breaks, the moment the pain becomes unbearable, the political pressure will force him to reverse course. And when he reverses course, when he admits defeat and turns the printer back on, the credibility of the Federal Reserve will be destroyed forever. And when the Fed loses credibility, the dollar loses value. And when the dollar loses value, silver becomes money again. So the Warsh nomination is not bearish for silver. It's the setup for the next phase of the bull market. It's the calm before the storm. Right now, the market is pricing in a strong dollar, higher rates, and the end of inflation. But that's a fantasy. That's hopium. The reality is that Warsh is walking into an impossible situation. The national debt is $40 trillion. The deficit is $2 trillion a year. The entitlement programs are unfunded. The only way to service that debt is to inflate it away. Warsh can talk tough. He can raise rates for a few months, but eventually the math wins. The printer wins, and silver wins. But while we're talking about central banks and interest rates and the Fed, there's one final piece of data that we need to address. Because the profit-taking bloodbath that just happened, the 22% crash, was not just driven by margin calls and JPMorgan reports. It was driven by something more primal, more human, more understandable. And we need to talk about the psychology of the retail investor. We need to talk about why people who bought silver at $30 just sold it at $120. And we need to explain why that's the biggest mistake they'll ever make. Let me tell you a story. Imagine you're a retail investor. You bought silver 2 years ago at $30 per ounce. You listened to people like me telling you that the system was broken, that inflation was coming, that silver was going to explode. And for 2 years, nothing happened. The price went sideways. It dropped to $25. It crawled back to $35. You started to doubt. You started to think you made a mistake. But you held. You stacked. You believed. And then, in January 2026, the rally began. Silver went from $60 to $80, then $80 to $100, then $100 to $122. You're sitting there watching your $30 purchase turn into $120. That's a 300% gain. That's life-changing money. You can pay off your credit cards. You can buy a car. You can take a vacation. The temptation is overwhelming. And then you see the headlines. JPMorgan says, crash is coming. The price just dropped 10% in a day. Your gains are evaporating. The voice in your head says, take the profit. Don't be greedy. You already won. Sell. So you sell. You sell at $115, $110, $105. You lock in your gains. You feel smart. You feel relieved. And then you watch. You watch as silver drops to $90 and you feel vindicated. You say, see, I sold at the top. I was right. But here's what you don't realize. Here's what the banks are counting on. You just sold your insurance policy right before the house catches fire. The crash from $122 to $90 is not the end. It's the intermission. It's the shakeout. It's the moment where the weak hands sell to the strong hands. And when silver goes from $90 to $200, when it goes from $200 to $500, you won't have any. You'll be sitting on the sidelines with your $115 profit, watching the real wealth transfer happen without you. This is the game. This is how they win. They make you rich enough to sell, but not rich enough to be free. So here's the verdict. Here's what you need to understand as we wrap up this emergency broadcast. The crash from $122 to $90 is real. The pain is real. The fear is real. But the fundamentals have not changed. The supply deficit is real. The industrial demand is real. The monetary crisis is real. JPMorgan's $50 prediction is not analysis. It's propaganda. Marko Kolanovic has been wrong on every major call for years, and Kevin Warsh's nomination is not bearish for silver. It's the setup for the next explosion. If you sold at $120, I understand. You locked in gains, you played it safe. But if you're holding, if you stacked at $30, $50, $80, do not let this crash shake you out. This is the test. This is the moment where the diamond hands are forged. The weak sold yesterday. The strong are buying today. And when silver breaks back above $100, when it clears $150, when it runs to $200, the only question you'll have is, did I hold or did I fold? This is the money code. The crash happened. The blood ran. JPMorgan issued its warning. But the bull market is not over. It's just getting started. The shakeout is complete. The next leg up is coming. Do not let them steal your position. Stack hard. The storm is just beginning.